Welcome to the December Investment Strategy Brief, the last investment strategy brief of 2019. As we like to do, we're going to review the macro market environment as well as observations on some key topics and themes. Let's again start with a look at the equity markets. Well, we all know the story in 2018. It was a bit of a roller coaster with markets up through the third quarter, rolling over in the fourth quarter on comments from the Fed that they may overshoot. 2019 started out strong and was influenced by a shift in Fed policy, but trade tensions entered the picture in May in particular, and trade tensions eventually turned into a trade war. In May, markets rolled over a little bit, but since then, really, markets have been strong, and the full year of 2019 is shaping up to be very strong for the equity markets around the world, led by the U.S. Now, recently, there were 4 events that have continued to support the equity market. The first is the December Fed meeting. Now, they kept rates constant at the Fed meeting. They didn't cut again after 3 cuts this year, but it was really their messaging saying that they believe monetary policy is in a good spot for continued expansion. We also saw a December ECB meeting, the first where Christine Lagarde led that organization and that meeting, and we see continued support there and an indication from her and from them that they'll have a 2020 strategic review. We had the UK elections in December with the Conservative Party winning handily, which really means that Boris Johnson is ready to essentially execute Brexit, likely in January. We had a phase 1 US-China trade deal announced by President Trump. And again, details are being firmed up, but it looks like that could be signed in January as well. All 4 of these things supportive of equities. Now, the Fed tends to look at things like asset valuation. They do so in what's called their financial stability report. And they have observed that asset valuations are somewhat elevated, but also observed that that is supported by basically low interest rates. They've also shared views on borrowing, pointing out that household borrowing as a percent of GDP is okay and in fact declining. And generally speaking, overall, they signal the U.S. financial system to be stable. And that's really one important input to our macro work. When we take a step back, we like to look at the macro environment, the market environment, headwinds and tailwinds that are developing, and themes. And a few things on the macro side: central banks remain accommodative. Manufacturing is stabilizing. We're seeing lots of geopolitical activity, many anchored in protectionism. We're looking forward into 2020 to a presidential election here in the U.S., and currently, day in and day out today, the impeachment inquiry in focus. So when we take a step back and look at what we thought about at the beginning of the year, it was really about resolutions. We were sitting back in January and we said, gee, what we think is going to happen this year is Brexit will happen, U.S.-China trade, a deal will happen, the Fed will be accommodative, and in a world of DC gridlock that will actually see some bipartisanship. And again, in some ways, all 4 of these things have occurred. Brexit is on track to happen in January. The U.S.-China trade deal phase 1 was just announced. The Fed did shift relatively early in the year to a more of accommodative stance, and we've actually seen some bipartisanship. The USMCA, a spending bill that includes parental leave, and the creation of the Space Force. So all in all, we expected animal spirits, which is really the optimism that drives the markets, to be improved, and they have. Now, when we do this work, one of the things we're observing is that geopolitics are becoming ever more important. So as we've reported before, we created what we call our geopolitical dashboard. Things that are included here were Brexit, or our Brexit, DC gridlock, a focus on North Korea. But 2 things I'd point out specifically. Number 1 is U.S.-China competition. So even after a trade deal, really what we have to acknowledge is that the U.S. and China will be in competition really for decades to come. Another thing, as I've mentioned, the 2020 presidential election. And one of the lenses we're looking through is asking the question, how business-friendly are each of the candidates? Now, turning to the macro environment. Let's start with a checklist on the economic cycle. This is something we use to try to gauge the risk of recession. We have 13 measures we're watching, and really 10 of them are signaling continued expansion. There are three that are sort of slight cautious measures. One, the yield curve, which flattened, and we'll talk about that in a minute. Second is wage growth, which is positive, but that can lead to inflation. And then third is really softer truck shipments. So now when we're monitoring the economy, we like to go sort of segment by segment. By far the biggest segment in the economy is the consumer. and the consumer remains strong. We see strong retail sales, we see strong earnings for the consumer, and overall confidence very, very positive. And what that means is that confidence and those earnings are supporting those retail sales, and that's all good for the economy. Now, when we focus in on housing, which the consumer cares about, it's held up generally. The NAHB Home Builders Index is very strong. Home prices are up. Housing starts continue. And while they ebb and flow, existing and new home sales have been mixed to positive. Now, more to the point too, then low mortgage rates have tended to help. Now, let's take a look at business readings. Business results have also been mixed to positive. The NFIB Small Business Optimism Index is very strong. Market PMIs, both service and manufacturing, are above 50, meaning expansionary. But we've seen cracks in manufacturing, in this case on the ISM Manufacturing Index. And so let's take a look and understand how business contributes to GDP. To do this, we look at the measure of non-residential spending, that contribution to real GDP, which is really business. And as this chart shows, when we pick apart the third quarter results, essentially that has turned negative. So we're watching it very carefully. One area that we look at is CapEx. When we look at CapEx, both planned and actual, we actually see some recovery in recent months. So all in all, we see mixed results on the business side, but generally we still think on average positive. And by the way, a trade deal with between the US and China should reduce uncertainty and really should help business. Now let's take a look back again at the data and specifically inflation. This is something the Fed watches very carefully. They're really curious and interested to know whether inflation is getting near their 2% target. And most measures that we track 7 altogether on an active basis, are still well below that 2% target. But two most recently have bumped up against it. One is CPI, the second is core CPI, and that's for the most recent reading. When we look at those two measures over the full year, they're still below 2%. But I will tell you that as we go into 2020, it's one of the things we're really going to be focused on is, are we seeing increased inflation? Because it's the kind of thing that can really sort of hold the Fed back in terms of taking action if they need to. Now, what are some of the other things the Fed's watching? Well, there's employment, like jobless claims. There's models like they've built, like the Atlanta GDP Now model, which is showing almost 2% growth. And then there's business conditions, which have been balanced. So all in all, these measures are reflective of a positive environment, and that's consistent with the Fed's messaging and their views on their current policy. Now, digging a little bit more on employment, this is really a record environment. So ADP jobs are up 66,000. That's off a little bit from even more strength in more recent data. Earnings growth at 3.1%, which is very good. Jobless claims at 224,000, which is also very good. But the real key number on this page is unemployment. Unemployment rate at 3.5%, which is really at a 50-year low. So generally speaking, employment remains very strong. Now let's take a look at cycles. I want to start with the economy. We're 10.5 years into this expansion. And as you can see from this graph, it's really lower for longer. But on the upper right, what you can see is that these expansions, they go for a while, and then we roll over into a recession, and there's contraction, usually much more short-lived and less magnified. So that's something that, again, we're watching for, is do we see a recession on the horizon? We don't actually anytime soon. We're thinking at least, again, 12 to 18 months. Now, the cyclicality applies to the equity market, too. We're over 10.5 years into this bull market with a cumulative return for the S&P 500 of 372%. But we do have to get ready. The chart shows that bull markets, just like economic expansions, eventually end and are interrupted by bear markets. So it's the kind of thing that we're watching for. And it's usually the bear market occurs either just before or as we head into a recession. So what are we watching to see if the market's topped? Well, we have a model that we look at that includes 9 measures. Things like a flow into equity funds, rising real rates, a shift towards defensive leadership, and widening credit spreads. And the bottom line is that really none of these have turned negative, and none are showing a pending bear market. Now, let's take a look at our market monitor more generally. We like to start with interest rates. Now, the Fed has obviously over the last couple of years first increased rates, and then this year they've cut rates 3 times. We saw, as I mentioned earlier, the 10-year touching the 2-year, so the curve flattened, and then it has since the 10 years increased again, so the curve is steepened. And then spreads, which is really the amount you get paid to invest in corporate bonds rather than treasury bonds, they basically stayed in a range, which is good. Now let's look at some other credit trends, though, because that's something that both we and the Fed are focused on. We're looking for cracks. And one of the things we're watching relates to credit standards. So subprime auto loans have become very popular. And recently, delinquency rates on those subprime auto loans have increased. Another thing we're looking at is leveraged loans. If you go back to 2007, 29% of these kinds of loans were issued with what are called covenant-light terms, so not too constraining. Nowadays, it's 78% of those loans that are issued that way. So it just makes it a little easier to do the loan, but a little bit harder for the lenders to get their money back if needed. Now, there's also a lot of negative yielding debt. And then when we roll this all up, though, we look at the Fed's recent financial stability report. They describe the financial system as okay. Now on to equities. We all know that U.S. equities have performed well in 2019, as I mentioned a few minutes ago. One result of this is that valuation, as measured by the price-to-earnings ratio, or PE, is above the long-term average. So markets, from a valuation perspective, are a bit rich. And what matters a lot is how earnings are doing. So let's take a look at that. When we looked at third quarter earnings in that earnings season, we saw once again positive earnings surprises. Those continue to sort of hit, which is supportive of equities. Now, when we look back at full years, let's go back to 2018, we saw 20% earnings growth. Now, this year, the earnings growth expectation with 3 quarters behind us is for earnings overall to be flat, so think 0% return. And then next year, the forecast is for just under 10%. So when we add all those 3 years together, you have, on average, a 10% per year earnings growth, which is actually pretty good. Now on to non-U.S. equities. Like the U.S., non-U.S. equities have had a very good year. And on a PE basis, that's price to earnings ratio, they have also climbed. So valuations are up, but perhaps not as sort of richly valued as the U.S. markets. And so that's something, again, that we're watching very carefully. Now, what about the dollar? When we started the year, we had the view that the dollar had appreciated a bit and probably wouldn't appreciate further in 2019. And it really hasn't. And after 3 cuts this year in the U.S. by the Fed, the stage is in some ways set for a possible dollar weakening into 2020. Now, let's take a look at our leanings overall. We like to guide our clients to invest in a diversified way, invest strategically in various asset classes that can include U.S. stocks, non-U.S. stocks, emerging markets outside the U.S. It can include investment-grade bonds for taxable bonds, or it can include even high-yield bonds. And those can often be long-term strategic allocations. But we also have leanings that are more short-term in nature. Currently, we're overweight large value, we're overweight Europe, we're short duration in anticipation of rising interest rates, and we're overweight corporates. Now, let's also take a look at the themes that have developed this year. Well, we've talked a lot about, even in this session, the fact that we're late cycle. We're very mindful of that, well over 10 years. And so we keep looking for signs of a recession and for bear market triggers, but we're not seeing any yet. Another theme, of course, is central bank support, monetary policy, especially the Fed. The Fed, in the current environment, has played and will continue to play a key role. Finally, we're looking at U.S.-China trade, but beyond that, U.S.-China competition. So with trade, things don't end. We're really going to be competing with China really for decades to come. So I want to thank you very much for watching this investment strategy brief, and we look forward to bringing you the next investment strategy brief in January, where we'll both take a look back at the full year of 2019 and review our outlook for 2020. Thank you.